battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the 110th episode of Weekly Insights, the Nick Stenger Show. Thank you for joining us for another episode of giving you the clarity and confidence, giving you the good news, the data, math, statistics behind what's going on in the economy. That's what we want to do here. You will remember, for the past 42 long years, our firm, Stenger Family Office, has been delivering clarity and confidence to help secure your financial future. This week's call and article is entitled Swimming Naked, which we will explain in just a couple seconds as well. And don't go away. We've got another wonderful guest interview for you today. Big time interview with a gentleman named Mr. Neil Gissler, who was the former COO of a company called Dentsu, which is a massive organization, over 50,000 employees, I think in 165 countries, and he just was excellent. So you got to get on the second half of today's show. Don't go away after the monologue. We've got an awesome interview on today's show. Swimming naked. Well, let's talk about where that term comes from. One of Warren Buffett's most famous quotes of all time: "It's only when the tide goes out that you learn who has been swimming naked." What that means is that sometimes during these various market periods where interest rates are low and things are easy, they even call it easy money because it's cheap. It doesn't cost a lot to borrow, like we had during COVID when interest rates were zero. If you were like my wife and I, who refinanced our house at a 2.5% mortgage, that's called basically free money. That is all gone. And if you are trying to buy a house today, for example, your mortgage is most likely close to 6.5%, maybe even 7% was the most recent high number that I heard. Wow, what a big difference. And that is the opposite of easy money. That's when there are restrictive financial times. Things are getting tighter is the actual technical term. And the Fed is pushing us, at least trying to push us, into a period of economic slowing rather than economic expansion. When you're going through those times of low interest rates and money is cheap and easy, the problem is a lot of ordinary investors, just regular people, start to look like superheroes. They start to look like they can time the market and trade and pick stocks. And then all of a sudden, when that tide goes out, the tide going out being interest rates going up, as that starts to happen, these people who used to look like heroes start to get wiped out, or at least can get wiped out. That is what you're seeing today. And I do not 100% blame the companies themselves. I don't blame their management teams all the way. Obviously, they get some of the blame. And like you saw at SVB, not the great risk management processes that we would have wanted to see at a bank. So they definitely get part of the blame themselves. But I would blame the Fed. The Fed was complacent. They were not on top of inflation like they should have been. We told you in 2020 and 2021, when the Fed called interest rates and inflation transitory, we said that that wouldn't be true. And we said that inflation would be here permanently, and that is sure where it is today. We'll get into where inflation is going to go. I think it is going to actually subside. I think we've gotten pretty close to peak. The problem is not really the inflation itself. It's how the Fed has dealt with it. They should have raised rates a little bit in 2021. 2021 to combat this. If they would have raised a few times, they would have really slowed things down and we might have been okay. But rather, they kept rates too low, and I think now what's going to happen is they're going to keep rates too high for too long, and that's going to be another significant problem. So if you are on a plan, if you are on a long-term investment strategy like we've got you on, if you're a portfolio management, not a market timer, and we have drawn the difference between this for the past couple weeks. If you've been on the show, remember 110 episodes now, you have heard me say this. Maybe you're sick of it by now. There's a difference between market traders and timers and people like us who are portfolio managers who are tasked with the allocation of your capital. You do not, and please don't do this if you're one of our clients or somebody that's just listening to the show today. do not listen to the traders and timers because there's no incentive for them to be right. They are in existence to help CNBC or Fox Business sell articles and to get clicks. They're going to come out and tell you, hey, doom and gloom and get in and get out and all the rest of it. But the portfolio managers, the people that are actually keeping you on a plan, the people who have to allocate capital, which means invest your life's work into some sort of companies or investment plan, we have to be right. And that's who you want to listen to, whether it's us or somebody else who's managing money, who's had a good track record over a long time. That is where you want to go. That's what you want to listen to. And it's not that we're right all the time and nobody's right all the time. You try to be right more than you're wrong, certainly. But the idea is that you are on a long-term plan, not panicking, not getting overly excited on the different things that happen in the market environment. One of those things was overloading on tech stocks. You saw a lot of people do this in 2020. Remember the Peloton craze? And I'm not saying there's anything wrong with Peloton as a product or a service, but just the stock itself just went nuts. It just became overvalued. There's no question about it. And it was valued, I think, at $50 billion at one point in history. And now it's not even close to that. Part of the problem is people just get these blinders on. They stop looking at things with the perspective of history, and they start to just think that the good times will always last. That's mistake number one that you can make, is thinking that things will never get bad, that things will always be good. That's mistake number one. Mistake number two is you think that things will always be bad and that things will never go back to normal and get good again. And the reality is that things do change. The pendulum swings. We go from good things to bad things, from good times to bad times. You just got to stay in the middle. You just don't want to buy into this doom and gloom when everything's awful and horrible and the sky is falling and nothing's going to ever get better. Don't buy into that. But then at the same time, you just got to be careful. You don't want to buy into the overly optimistic tone where there's no reality. And so as portfolio managers, we just want to bring you back to earth and keep you on a long-term plan that's based on data, math, statistics. I always talk about that. I always talk about the data and the math because these statistical studies and surveys, while they're not always right, and history isn't always a guide for the future, it's not like history always repeats itself, but we all know the saying, it sure seems to rhyme. That's what you have to go off of. You have to go off of the long-term averages. And long-term averages, for example, would say that stocks return to their mean returns over time. And if stock returns are supposed to be 9 or 10%, well, over time, stock returns will probably return to 9 or 10%. It's just the law of averages. And if interest rates are supposed to be 4 or 5, and that's been the average for 200 years, well, probably interest rates will hover around that 2 to 3, 4% zone. You shouldn't be surprised when that happens. You ought to be on a plan that keeps you allocated, diversified, and rebalanced, which we're going to talk about next, over these different cycles that happen in the economy. So, 5 big risks. There's way more risks than this, but in our experience, remember, we have dealt with over 1,200 families like yourself the past 42 years. I would say we have a pretty good understanding of what are the big risks out there and what has really blown people out of the water on their plan if they're not careful. I think it boils down to 5 core risks. Risk number 1 is under-diversification. It's in the name. It's not rocket science, but if you put all your eggs in one basket and that basket turns out to not be the right one, you can get absolutely blown out of the water. You want to be diversified. Now, obviously, under-diversification can result in big gains. And if you happen to pick the right stock or you happen to pick the right sector, you can do really, really well. If you're on a plan, though, and I would say most clients that come to us looking for a plan, looking for us to manage their money, they're not looking to blow it out of the water. Yeah, they want to get good returns. Yeah, they want to do well with their returns over time, but they're not looking to bat 1,000, and neither are we. We want to keep them right in the middle of the road. Yeah, we're going to get the good returns. Yeah, we're going to do just fine over time, but we have to follow a rules-based approach with our risk management process. Remember, we do the annual due diligence process, and we rebalance once to twice a year. But we just have to go back during that process to a rules-based approach with your portfolio that is going to cap your sector and stock exposure at an acceptable statistical limit. What does that mean? Well, it just means that we don't want to put too much in one thing. You do not want to have all your net worth in energy stocks. You do not want to have all your net worth in tech stocks. You want to have a mix. You want to have a handful of sectors, a handful of companies that you're rebalancing over time. And then part of that rebalance is to take some profits from the things that have done well and then reinvest those profits into things that are underperforming. It's not a guarantee that you're going to never have a correction or a recession or a downturn in the market, and the market was down 20% last year. But the idea is that when the market's down 20, we want to make sure you're not down like 40 or 50. And you may think that sounds crazy, but I'm telling you, I've had people come in, prospective clients, who say, Nick, I was literally down 40% last year in 2022. And that is the risk. You do not want to get clobbered. And if you're doing a careful risk management process, you're staying invested, you're not trying to time the market, which is risk number 2, you're just staying in the middle of the road, you will not get blown out of the water. You'll kind of not always, again, bat 1,000. You're not always going to knock it out of the park and make enough and own enough of something to make a killing, but you're not owning so much of something that you just get completely wiped out. And there is plenty of history to show you that people have gotten wiped out over time if they're not careful. So that leads into risk number 2, market timing. You may think you are a genius, that you can time the market, that you can get in and get out, and you know when to buy and you know when to sell, you know when to hold them and when to fold them. If you go back to the statistics, the data, the math, all the research that has been done over the past 200 years, you know that market timing is a failed strategy. Don't fool yourself and think that you'll be right twice, knowing not only when to get out, but when to get back in. So yeah, you might be right getting out of the market. You might have sold out at the all-time record highs, but guess what? Now you're sitting in cash. You got to know when to get back in. And if you don't get back in at the right time, you could miss the market's recovery. And we have seen so many people. There are more people who have gotten blown up with their financial plan by missing the market's recovery than actually in the correction itself. I think it was Peter Lynch, famous mutual fund manager, who said more money has been lost preparing for corrections than in the correction itself. Don't lose a bunch of money trying to prepare. Stay invested across the whole cycle rather than trying to time the market. That is not active management. And don't get this wrong. We are obviously engaged in the business of active management. We want to keep you on a plan and be constantly looking for the newest opportunities and where we should be and all the rest of it. That's important. Market timing is not that, though. Market timing is not the business of trying to get in and get out. Active allocation, active money management is the process of asset allocation. It's strategic. It's not tactical. It's strategic, which simply means you want to know how much of your portfolio you feel comfortable exposed to various sectors, various asset classes, and then just stay on that plan over time with small tweaks. What I mean by that is during the early days of our business in the 80s, we were coming off of these crazy high interest rates, and interest rates were precipitously falling, and inflation was starting to fall. We went from a 19% treasury back to like a 6% treasury over a period of time. That is what we would call a bond bull market. Remember, interest rates, bond prices, inversely related. So if interest rates go up, bond prices go down. Interest rates go down, bond prices do very well. They go up. The 60-40 portfolio during a lower rate environment, when the rates are coming down off of all-time highs, a 60-40 or a 70-30, 60 being stocks, 40% being bonds, can do very well. But when you're in a rising rate environment, putting that much of your portfolio in bonds can just be a disaster. And so you have to be actively engaged in watching the broad economic environment, watching where you're at with your personal plan, whether you're 65, 75, 85, 25, wherever you are in life, and make sure that asset allocation strategy matches your long-term plan. here's an easy example. If you're in a rising rate environment like we are today, you want to pivot from long-term assets, whether it's a long-term bond or a tech stock, usually into a shorter-term asset like short-term treasuries like we are today, or even dividend-paying stocks where you're getting current income rather than having to wait till the future. That's how you want to plan your portfolio out. Because if you mistime the market, nobody talks about when people mistime the market. If you get it wrong and you miss just a handful of the best market days, everybody knows this research, you can look it all up. If you miss the best days in the stock market, you can really screw up your long-term return. So that's number 2. Number 3, the Federal Reserve. We vote for our president. We vote for the House of Representatives. We vote for the Senate. We vote even for our local representatives. But nobody in this country votes for the Federal Reserve. And that's risk number 3. The Fed has become this quasi-massive, behemoth fourth branch of the government, very bureaucratic, very, very authoritarian, that happens to hold more power than the other 3 branches of government combined. There's a famous saying by this guy, Martin Zweig, he was a finance professor and investor, wrote a bunch of books that are excellent. I recommend them. But he said, don't fight the Fed. What that means is when money is easy, when interest rates are low, don't be surprised if companies with bad fundamentals do extraordinarily well and see their stocks go up. But then when times are bad and money's getting more expensive and interest rates are rising, don't be surprised on the other side that a company with great fundamentals, with a great balance sheet, can really get squeezed when the Fed is raising. You do not want to fight the Fed. It is going to be very challenging. Now, interest rates are at 5, almost a little over 5% that you can get on a treasury right now. I believe that interest rates could go up. I don't think that's correct. If I was running the Fed, and by the way, they've never asked me, but if I was in charge of the Fed, I would pause. I would pivot right now. I don't think I'd raise anymore. That doesn't change the fact that the Fed is probably going to raise. And there's a good chance that the Fed could raise to 6%. If that happens, it just completely changes the game of equity returns. Because if you can get 5 or 6% risk-free, relatively risk-free, on a bond, on a treasury, you got to get a lot better on a stock. You have to be getting 10, 12, maybe even 13, 14% to make the risk worth it. And companies do the same thing. And instead of investing in new projects when rates are high, they tend to hold cash and be careful, and they do layoffs. Like a couple weeks ago, we did the episode, Layoffs Are Coming. That was right on the money. You're seeing this happen in real time. These major blue chip corporations that typically don't lay off people like the tech companies do are laying off in droves. They're doomsday prepping. They're getting ready for what they think is bad news ahead. And that's exactly how the market works. It's a forward-looking indicator of what's coming. If you're not managing the Federal Reserve and interest rate risk properly, you could end up like SVB. And if that happens, you collapse under the weight of crushed bond prices. This is the big risk, and that's why we want to be very careful. We do not want to put you in long-term debt if we don't have to. We want to keep you kind of short-term. Okay, risk number 4, inflation risk. Like Milton Friedman once said, inflation is always and everywhere a monetary phenomenon, which in simple terms just means that when the government prints money, when the supply, the amount of money floating around in the economy rises, the value of that money becomes worth less. It's as simple as that. When you print 45% new dollars into the economy, roughly over time, the value of those existing dollars becomes worth 45% less over time. The past 200 years of U.S. economic history have proven one thing, and that is that both sides of the political aisle, you can't just blame it all on the Democrats. You can't just blame it all on the Republicans. You blame it on both of them. I've called it the uniparty that D.C. has quickly become, just a massive behemoth, bureaucratic, big government that is stomping out the face of the small business owner, the individual. Both sides of the political aisle have printed money into oblivion to achieve their policy goals. They have bought into this narrative that you don't ever have to raise taxes, that you don't ever have to raise bonds, that if you want to do some social spending or some military spending or whatever you want to spend money on, you just print the money. What a goofy idea. This idea of modern monetary theory is just terrible. And so if you live long enough which is basically more than 5 years, you're going to watch your purchasing power plummet over time. And if you don't own enough equities, remember, equities have the power to beat inflation over time, you can run out of money during your lifetime. Simply what will happen is your purchasing power will slowly decline. Like if you had $100,000 in a bank account in 2019, that $100,000 today is worth closer to 60. Who has the power to at least keep up with that inflation or maybe even beat it over time? Equities, companies. When you invest in a company, they have pricing power. And I can't say the name of the company, but I was looking at a balance sheet and an income statement for a company the other day. It's a retailer that does food service. It's a restaurant company. And they literally said right in their 10K report from last year that we raised prices 12% to battle the increased input costs, higher labor costs, higher supplies costs and ingredients and all the rest of it. We raised our prices. That's why you own equities. You own equities because they have the power to beat inflation over time, unlike any other asset class. Certainly better than cash, definitely better than bonds. To a degree, real estate can beat inflation if you're in the right stuff. But even commodities can beat inflation, but you just have to time them right. That's why I think equities provide the best passive return for investors over the long run. Even as you age, even if you're sitting there thinking, Nick, I'm not 25 or 35 years old anymore, I'm 75 or 85 or even 95, stay in equities because eventually what will happen is somebody will inherit your assets, you'll live long enough, inflation will eat you alive. You've seen this, like my wife and I, we go to Jewel-Osco, the grocery store near our house. It used to be $100 for 2 bags. The same 2 bags today are pushing $160, $170, and we're getting less and less food for the same amount of money. That's inflation risk. Okay, let's end on risk number 5, behavioral risk. And for all the risk out there that you can't control, for the stuff that we just have no control over, no power over, like the Fed, like market forces, like horrible things and doomsday events that happen, we know as equity investors that these bad things are going to happen. That's the good news. The good news is we know over time that there will be doom and gloom, and it's going to shake people to their core. But the fact of the matter is how you react to these doom and gloom events, how you respond to the bad stuff that you know is coming really is going to be the difference between your long-term financial success or your failure. If you don't react well, if you respond and you have a knee-jerk reaction and you sell stocks anytime you see a bad story come out on CNBC, you are going to blow up your plan over time. There's been plenty of stuff in the past, 10 or 15 reasons almost every year on why you should panic, why you should get out of stocks and get into gold or whatever and silver and build a bunker in your backyard. And for all of those doom and gloom bad reasons, for all the 10 or 15 reasons last year to panic, just remember there will be about 10 or 15 more next year on why you should panic and get off your plan and go to gold and cash and build a bunker. Don't buy into the narrative. Do not buy the doom and gloom. Stay on your plan. Tune it out. Buy good stocks. Hold them for the long run. It's not going to ensure that you never have problems or risk or that your portfolio is going to be insulated. But what it does is it keeps you in the middle of the road. Why? So you do not get blown out of the water. Control your own behavior. Control your own risk. And if you have a tough time doing that or think you might have a tough time doing that, hire a financial advisor. Get somebody like us. Get somebody good, even if it's not us. Get a good financial advisor who can help keep you and coach you on your long-term investment plan. That's all I've got for you for the monologue today. Thank you for being on the 110th episode of the show. Don't go away. Stick around. We've got Mr. Neil Gissler, our special guest interview today for the second half of today's show. Thank you so much. We'll be right back. All right, ladies and gentlemen, welcome back to the 110th episode of the Nick Stenger Show. We are joined, as always, like we've been doing on these weekly shows, by another wonderful guest with us today, Neil Gissler. He is the former Global Chief Operating Officer at Dentsu, which is a global company with 50,000 plus employees, 185 different brands, operating in 65 different countries. Neil, are you with us?
I am, Nick. Thank you so much. It's great to be here with you today.
Yeah, well, it's thank you for joining us, and I think people are really going to enjoy your story. We try to, on these shows, give people a little background of what's going on in the real American economy, the global economy, so that they can stay the course. And you see all this doom and gloom out there and all the negative news and all the bad stuff, but when I talk to you, Neil, and a lot of people don't realize this, you're actually my neighbor. You're kitty corner to us in Naperville here, and funny story, you actually live in my great-grandparents' old house.
Yes, yeah. quite a history and set of connections over time.
Well, Neil, and what people are going to see from you today, I think, is just some optimism. And maybe I'm wrong. You can correct me on that. But tell us a little bit about your general view on where you've been in your career and why you think things. Where do you think the global economy is going over the next couple of years here?
Yeah. So just quickly, I've spent the last 35 years plus. Predominantly working in the IT and technology industry. I had 28 years at Accenture. And then, as you mentioned, I retired from Accenture and then ended up taking a role at a company called Merkle, which was acquired by Dentsu. But Merkle was a marketing and advertising services company, very tech-centric. And then Dentsu is one of the top 5 global advertising and marketing service holding companies. So it was a company that, as you mentioned, did business in over 65 countries. At one time had over 180 or so brands that had been acquired and built into the business over time. When I think about the global economy, it's been obviously a fascinating 3 years. And especially as somebody who was still working in a full-time capacity through COVID and really trying to navigate some of the challenges that the global economy, but certainly the U.S.-based economy, was affected by. And obviously with some of the either government restrictions and or the individual choice to minimize the associated risk and exposure to COVID, we saw obviously a material pullback in growth. Most businesses actually declined. If you go back and look at 2020 and 2021, except for those businesses that were inversely correlated to what was going on in the market. And so, at a time when traditional advertisers were spending less because people were out shopping less, they were out dining or traveling significantly less. Obviously, we saw the rise in streaming services and especially in services that provided in-home shopping and convenience like Amazon. So, we've been through an interesting ride the last couple of years. I think what's really exciting to see, while we are now in what feels like a pullback, we've gone from soft landing to the forecasting that we're going to have a kind of soft or light recession. At the end of the day, what is at least I think positive is that it's going to be a bit smoother or softer than what it could have been. I mean, I look back now and think about the financial crises that I lived through back in the early 90s, of course, post 9/11 in 2001, the financial crisis of 2008 and 9, and you kind of look at where we are today. I think the overall economy is going to come out of this okay. So I'm expecting that we will still see some growth this year, but that we would return to more material growth next year. But I think what's so complicated today is the amount of financial engineering that has taken place, and that really came to light so materially back in 2002, 8, and 9. And then again, if you look at now the mass manipulation by the Fed to try to rise interest rates and control of inflation, again, my biggest concern when I look at those types of things and how they're affecting the economy is how relevant are the factors that are being used today to project, what is the real inflation rate and what are the real drivers of it. And is interest rates really going to affect that to the degree that the Federal Reserve would like it to? And I think when we look at this current trend and what's transpired here, we've seen massive raises in rates, unprecedented. I think maybe one other time in history at the level and speed that we're currently at, Nick. But at the same time, inflation has not really slowed anywhere to the degree. And of course, there's a lag to that response, but I'm not sure that we really have a full grip on unemployment and what do the numbers really mean, who's included, who's not. And I think we would benefit from some of an overhaul of some of the underlying data and analytics that are actually being used to drive some of these economic decisions like rate increases.
So I think people really are going to appreciate your background because you started off at Accenture and you were a managing director of technology North America and obviously had a fantastic career there. But your entire career, Neil, and again, tell people a little bit more about some of the operational things you've done. But you've been in the room making some critical decisions, the operating side of the business. I continue to try to tell clients that when you're investing in the market and you're investing in the companies like many that you worked with over your career, you're investing in people, right? You're investing in real decisions and assets and stocks or a claim on those assets. And so what's your perspective as an operating type person who has seen some of these decisions in real time?
Yeah, I think what's so critically important for businesses today is you've got to have a real understanding of the market you're serving and how that market's going to evolve. And at the end of the day, that evolution is really the basis of your future strategy. And then what's the balance that you need to strike between how do I continue to service and grow a market today that's growing, that may be starting to flatten out, maybe starting to decline, and through that, or coming from that, is really the fact that it's being commoditized. And how do you strike that balance between extracting all the growth you can in what you do today, but investing in the future and positioning yourself for that future growth? And I think that's always a challenge for businesses is what's that right balance? And getting that right. But the thing I've seen happen so often, and I've seen this at various points in my career, at a variety of companies. As you know, today I'm really working kind of as an advisor, a board member, even in a fractional COO capacity, trying to help companies, is while you may have a strategy and you may have a multi-year financial plan, and you start to then lay out on a year-by-year basis what are your budgets, is how do you constantly try to push the team to achieve the aspirations around your revenue growth, but never getting ahead of the revenue as it pertains to the number of resources you need to hire or the number of products that you need to build. And I've spent my entire career in the services field, but so often I see companies take their eye off of the forecast, which is kind of a 90 to 120-day view, and really look to build their team based on a budget that the revenue may just not materialize, right? So how do you have the right pulse on my backlog? How do I have the right pulse and the right criteria being applied to my pipeline so that I've got a relatively realistic view of forecast? And how do I always hire and manage to forecast, but with a strategic eye to what my resource needs might be if I were to actually achieve my plan? And I find so many organizations, small and large, kind of really struggle with that. And then organizations get out over their skis. They end up building a resource base well ahead of actually what the actual near-term demand is. And then you throw yourself into a situation where you're not hitting your profit targets, which then starts to impede your ability to effectively invest in your strategy, and it becomes somewhat of a snowballing effect.
So coming from the consulting world, the Accenture world, you saw a variety of different businesses, right? Obviously in the services sector, but tell people a little bit about what were some of the common themes you saw? What were some of the problems operationally that you were addressing? Obviously you mentioned some of them already, but what were some of the common themes that you were able to come in and say, okay, hey, let's do this a little bit differently? Or what did people really need help with?
Yeah, so at Accenture, I mean, we were clearly a services business, but we served clients literally in every industry, from manufacturing, services, like financial services, banking, healthcare, et cetera. And a significant part of our focus, especially during that period of time, was really a little bit on their strategy from a business perspective, but really what did they need to do from a business process, organization, and information technology standpoint to achieve their overall business objectives. And those business objectives aren't uncommon to what most companies are focused on, right? Which is how do I drive growth? How do I provide a valuable set of products and services to my customers? How do I retain those customers? And then how do I do that as cost effectively as I can to deliver on the expected economic outcomes? I spent a tremendous part of my career really focusing in on the IT organization. And really that focus was on, do they have the right IT strategy to support and achieve that business strategy? So if the business strategy was going to move, for example, for a big box retailer from going to the big box store to a hybrid of big box and web, to now a predominantly e-commerce based business, what are the right systems that you need, right? So what are the right platforms that you need to do that? You obviously need a market leading set of e-commerce technologies that are easy to land a customer from an advertising page to be able to evaluate, search, select, and purchase product. But at the same time, what are all the underlying systems that you need to run the business, which spans finance, HR, supply chain, potential manufacturing, and how do you strike this balance? So I mean, one of the things that organizations have struggled with from an IT perspective for decades now is how much do I spend on my discretionary spend, which is the new value-added technology capabilities, versus how much do I spend on non-discretionary, which is keeping all the things I've already built running. And there's just been, of the 35 years that I was in the industry, just a massive explosion of technologies. And the pace at which those technology changes came was just overwhelming. If you look at it today, when I started in this industry, technologies changed every 8 or 10 years. Now they change every year or so. But how do you keep up with that? How do you take solutions that you've built and get the value out of them for a period of time? But how do you retire them? How do you replace them? And what most organizations end up with is this massive proliferation of underlying technology solutions that are very costly to maintain. And so they end up spending more and more on this non-discretionary spend. So if you look at the total of IT and technology spend at 100%, if you are 70, 80% plus on non-discretionary, you're not able to fully and effectively fund the things that the business needs to actually drive its growth agenda, for example. So we spent a lot of time working with clients to figure out, how do I drive cost out and reduce my non-discretionary to fund the discretionary and the new things that will bring new value to the enterprise or enable the value that's defined in the strategy. So that was a big part of my focus there.
Now, did you always have a tech kind of focus early on, like in college and stuff like that? Is that how you ended up at Accenture in technology, or what was your path to kind of figuring that part out of your career?
I'm laughing because that's a funny story. I mean, I graduated from high school in the south suburbs of Chicago, and I wanted to be a chemical engineer. After one semester, I was in LAS General. And what I discovered was I either no longer had the interest and passion, or maybe I didn't have the study habits necessary to be successful in that field. And I really ended up determining that I wanted to be in kind of the economic and finance world. So I got a degree in economics and a minor in finance. But I graduated in '87, which was Black Monday and a huge market crash, and nobody was hiring. But I always had an interest and some skills in technology. So I did some computer programming in high school. I did well in the courses that I had to take as part of my business studies at the University of Illinois. And when I went to interview on campus, Nick, it was a lottery system, and I was trying to interview in the fall of my senior year, but you were competing with fifth-year seniors, and I literally got one interview, and it was an interview for the Management Information Consulting Division of Arthur Andersen. And that interview to me was fascinating because never once did they mention that I would be doing computer programming. And so, but when I went there, I literally went through 10 weeks of training in computer programming. So that was kind of the foundation of where that started. And I was good at it and I liked it. And that's really how my career got started. So I really never was pursuing a career in IT or tech consulting, but that's where it ended up going. And then over the course of my career, while I always either was a developer or a technical architect and then ended up becoming a person who managed projects, I just continued to rise up through the ranks and then became a client partner and ended up then being asked to run major segments of our technology business. So my last large operational role at Accenture was I was running the North America technology business, which provided all IT and tech services that we offered to our client base. And that combined business, as it was brought together and I was put in place as the first leader of it, was about a $7+ billion business when you looked at all the clients in North America we served across what we called our 5 operating groups or industry portfolios. And I got to be in a role where I got to do kind of a hybrid of business, but in tech. So I owned understanding the market. I owned developing the business strategy. I owned defining the IT services that we would offer to the marketplace. I owned the building of those. I owned, in collaboration with our operating groups, how we took those to market and generating pipeline. And my team is supporting the sales. But then we ended up owning all of the delivery of those services. So had a significant responsibility around defining and managing costs to achieve profit expectations and those types of things. So that's kind of the quick history of how I got there. But I never intended to go there, interestingly enough.
So you get there, you're at Accenture now. You had obviously a very great career there. What are the, like obviously other than hard work and competency, which are important, but other than that, what do you think, what were some of the defining moments of when you're in the boardrooms with the CEOs and the management teams and you're advising these companies? Are there any critical moments you can kind of point to and say that was sort of a turning point in your career, or there were certain decisions that were made that were so important that they really propelled you to that next level?
I think about it there's probably some examples within Accenture as just one, and that was with our own leadership and really convincing them of a couple of new market spaces that we thought were going to be critically important to the future of the technology business and its growth. And that's something today that people talk about and call it technology consulting. This is like a commonly used term. Every major consultancy in the world of any scale offers technology consulting services. But I can literally remember back in 2003, a gentleman by the name of John Kaltenmark, who lives in St. Charles and is actually at the board at North Central there, still a good friend of mine today. He and I put forward a point of view around this new emerging market space. We literally went on a road show with all of the major companies today that really help evaluate technology markets and technology platforms. Companies like Gartner is one great example, and sold them on this concept of a technology service market. And we worked to define that market, and we became one of the first to really commit to growing that market, and really one of the initial marketing leaders. And Accenture today is in the upper right quadrant if you go look at that from a Gartner perspective. So that was such a pivotal point in my career because it really gave me exposure for the first time, Nick, to the C-suite of Accenture, and I would say the direct reports to the C-suite. And my last large operational role there, I was a direct report to one of the members of the C-suite. But it really took my career a long way from there to not only figuring out that market and how we would work collaboratively to drive growth there, but then how do you actually now take that beyond technology to consulting to all of our IT and tech services, which is what my last large operational role was at Accenture. If I think about it in the context of clients, I would say probably one of the biggest moments that was defining in my career was we had a client where we were helping them to roll out a massive set of changes into their business processes, organization, and the systems that supported how they manage their relationship with their customers, all the way through back-end billing and collections. And there were a series of issues that were delaying the deployment of the solution, and not only then delaying it, but then creating an immense amount of pressure on the business leadership to take the system live prematurely. And unfortunately, that decision was taken. But in the end, I was the one that was probably the most vocal and the most transparent around what the likely implications of that decision would be. And it would have been the easier thing just to go along with it, right? At the end of the day, it had implications to whether or not we'd be able to bill for our services or not, and all kinds of things like that. And at the end of the day, I stood behind the facts and stood strong in my position, and it ended up working out in the best that I did that, when it could have been just as easy. So my big defining moment there wasn't necessarily one in which we helped the client to achieve a significant outcome, but maybe help to prevent or mitigate some of the risks that were being introduced by some of the decisions being made. So not sure that resonates, but those are two that come to mind quickly.
Yeah, that's fantastic. Well, sticking to your guns during times of difficulty obviously is a refining moment. That's a fantastic story. And why do you think it is? And you look at, obviously, these Fortune 500 companies, and not to name any names specifically, but they're big bureaucracies, right? And they have lots of different, they're slow to adopt change, right? And so a lot of times they'll have to bring in a consultant or a firm like Accenture to do some of this stuff. But why is that? Why do you think is it sort of like a risk management thing that they would bring in a consulting firm to make sure they get it right the first time? Or what really is going on in corporate America? What's going on with these big bureaucratic organizations, these publicly traded companies where they obviously have lots of staff, they have the human resources to pull it off, but why do they engage with a consulting firm?
Yeah. I think there's many reasons. You mentioned one. I think it's a way to mitigate risk. I think a big part of it is most organizations don't have the level of retained staff. So even if you look at IT organizations today, large portions of IT are outsourced. And that allows companies to do a few things. It allows them to more quickly adapt to change in technology. If you think about 35 years ago, every IT employee was an employee. It wasn't a contractor. Today, I'll bet you the average is 20% employee, 80% contractor. And it's impossible to keep up on all the technology ways. The level of investment that a company would need to make is overwhelming. It's not possible, I don't believe. At the same time, it's not cost effective to hire full-time employees to ramp up and then have to ramp down because you're dealing then with attrition costs. And so in the end, it's probably viewed as more cost effective to use third parties. But when you start talking about transformational change, I think most organizations either don't have the leadership experience to drive that change, and or they don't even have the leadership to really formally identify and vet the change that's needed. Now, what's interesting about that, for me, having spent my entire career doing that, When I went to work for Merkle, and then eventually we got acquired, and I became the global COO of Dentsu, we ran a very large restructuring and transformation initiative. If people want to go out and read about it, you can go see it. It's disclosed in the company's financial results. It'll tell you a little bit more about the company and its economics and some of the things that we were able to achieve through some of the initiatives that we took. But some of the leadership had background and experience, but some didn't. Even though the ones that did, though, they had full-time jobs, right? So how do you transform a function while you're running the function? At the same time, how do you transform a function, or how do you even have it? If you're running a function, how do you actually transform it effectively if you don't run the transformation? But you could never do it with your own team, right? You're going to have to bring in consultants to augment them that either have that background experience, but certainly the capacity and the bandwidth becomes a major factor, Nick, in those decisions.
So, Merkle, you bring that up, and I was looking at we were talking a little bit about your background with them, and under your time there, revenue went from $500 million to $1.2 billion. Is that right? And then gross margin expanded by 800 basis points. Is that correct too?
Yes.
Wow.
Yes.
So how do you do that?
I've been told many times I need to write it down and put it in a book. I mean, it's a series of things. First of all, you have to look at what's the overall growth strategy and plan. So Merkle was a business that grew through a hybrid of organic growth and acquisition. So to get to that number, you're looking at 30+% growth on an annualized basis. We always strive to do that half organically and half inorganically or through an acquisition-based approach. But when you look at driving gross margin, so a simple P&L design discussion, in a services business like that, you typically have client margin. So it's all of your client revenue and the direct cost to service that client. And then you have gross margin, which is the inclusive of the non-client cost of your delivery staff. And then you've got all the things that sit within your SG&A, like your sales, client account management, finance, HR, technology, and IT, which then basically define operating profit. To really drive that kind of improvement, you really have to look at what are your costs that are allocatable to your clients, and especially your gross margin, and really establish what is the target cost that it can be achieved at versus the cost that's being achieved at today. And so, again, this is a people-based business. So there are 3 or 4 core levers that allow you to drive gross margin improvement, Nick. So first of all, I'm going to refer to your team as a pyramid of people. So at the top of the pyramid, you have the most senior, and at the bottom, you have the most junior. And every services business or every type of service in a business could have a very different pyramid. It really comes down to what is the leverage that you can drive to actually deliver the services and meet your clients' requirements and expectations. The next thing is, what is the comp and tenure? So are you effectively managing what the salary that you hire people at? Are you effectively managing how you do compensation increases and promotions? And then in a services business, you have to really take some tough decisions around tenure, because what you don't want to have is you don't want to have a 30-year employee at the bottom rung of that pyramid that you're paying $100,000 to do a job that somebody could do for $30,000, right? So you got to really understand that, and you got to really manage that. The other thing that really comes into play is, where are you going to do the work? Are you going to do it in a high-cost location like New York? Are you going to do it in a lower-cost location like Little Rock, Arkansas, or even India? So workforce mix is an important factor. And then the other major factor I would just say is, do you have the right number of people for the current demand of revenue? Like the thing I was talking about before, people get ahead and hire to plan versus forecast. And so if you have an excess amount of people and your utilization of people on your client work is low, that's going to be a drag on your gross margin profit, which is then going to drag your EBITDA down. And then lastly is, how much of work is being done by your own staff versus third parties? When you think about that, always much more effective to use your own employee base, because third parties, you're paying not only their cost, but you're paying their profit. And you now got to mark that up. But then if you mark that up too much, you're no longer price competitive. So you got to really manage the amount of third-party contractors that you might use in support of your business. So that's how you drive that kind of improvement in gross margin. The last thing I would say is you also need to make sure that you're pricing competitively to the market. And that means, one, that you don't sell work at an unnecessary discount. And then the other thing is that you're not coming to the market with a price that won't drive sales, right? You got to have a certain level of win rate to have that growth. So those are some of the major levers that you would focus on and pull to drive that. And then lastly, at the EBITDA or operating profit line is what is the cost of your business function? So sales, marketing, sales, finance, HR, IT. And I've always been taught and employed a percent of revenue target for those cost categories. And just, again, building your budgets and managing costs to do that.
So what's a boardroom meeting like? A management team Monday morning, CEO, COO, CFO are in the room, all the major company players. What's a boardroom meeting like? What are you guys talking about on a Monday morning?
So it's interesting. I've had a couple calls already this week, and the kind of things that we are talking about is the market. How much is the market slowing? How much is it going to grow this year? Where are we at as it pertains to, what we budgeted from a revenue, cost, and profit perspective? What does the current forecast look like? What are some of the needed actions to either drive more growth in certain parts of the business or do cost actions? These are all of the kind of big topics. In some situations, we even discuss major client, either opportunities that may be risky. We talk about major clients where we have client delivery problems and declining client performance. In a services business, you need to be retaining. If you want to drive double-digit growth, you need to retain 90 to 95% of your current client base on an annualized basis, and that revenue. If you're having to drive a much greater growth, for example, from new logo acquisition is just harder, right? I need more pipeline because I have lower win rates, and so I mean those are the types of topics that we're in. We also cover things like employee satisfaction and how we're doing there for employee retention. But it varies. Those would be more operational tactics. Some of the meetings are very focused on strategy, right? So for the first 90 days of this year, for one of the companies I'm working with today, we spent a significant majority of our time at that kind of director level, really defining where we think the market's going to go the next 3 years. What do we think our growth strategy will be? What do we think the economics of that growth strategy could be? And we were also working with an advisor because we're going to take that company for an initial round of PE funding. That's actually kicking off next week. So, those meetings were obviously quite different. They're much more strategic than they might be tactical.
So let's talk about Dentsu. You're helping run a massive organization, a global operation. What does that look like? Are you you're on the road probably a little bit, I could imagine, right?
Not really, because we were in COVID, so nobody was going anywhere. So we actually did all that remotely for 20 and 21.
What is that like, running a business like that remotely?
Well, it's pretty fascinating. I mean, I think what was eye-opening, and I mean, I had this general view, but I think what was eye-opening for many people was the fact that we can actually effectively run the business and deliver service to our clients working remotely. I grew up in a world where we used to fly out Sunday night at Accenture, and you didn't fly home until late Friday after the clients left to go home for the weekend. And as a guy that was 22 living in Lincoln Park, that was a pretty brutal lifestyle. I spent most of my time trying to figure out how the hell I was going to get my dry cleaning done to be able to take it back on a plane, because back in those days we all wore suits like you do today. When you kind of roll that forward, Nick, and I look at it within the context of Dentsu, I think a lot of people were surprised by our ability to do that. But we adapted very, very easily to doing that. But again, what was interesting about the Dentsu business, it was, again, as I've already shared, kind of the 4 billion pounds business and operating in 65 countries, over 180 individual brands within the holding company, and we were implementing a strategy to actually move it into a consolidated business. So rather than having 180 plus brands, really having 3 major lines of service, what we called our creative services, our media services, and our customer experience management services, and trying to drive that transformation, which would enable us to achieve our restructuring and financial targets and objectives. At the same time, we're trying to run the business, right? And which requires you to not only be able to continue to drive pipeline, close opportunities, deliver services, and be able to effectively manage and retain our people at the same time while we're trying to make all these changes. And so it was extremely complex in a normal world, but even further challenged, of course, in a virtual world. But I think it was predominantly effective. It was harder, I think, when you're rolling out things like an operating model change, which was around how we would be structured, the major lines of service, and how we would be organized globally, regionally, on a country basis. To do that is so hard to read the room when you're sitting there on a Teams call, kind of presenting this stuff. They can see your face, but you can't see their face. And how engaged are they? How many of them are doing other work? How many of them are going and running a load of laundry, right? So it was certainly complicated by that, but also a kind of a fascinating thing to go through. I wouldn't want to go through that again for a lot of reasons.
Well, there were a lot of COVID puppies back then too. A lot of dogs that needed to be walked and on Zoom calls, and so the term "new normal."
Kids educated, kids babysat. Yeah, it was all of that.
Did you subscribe to that idea of the new normal? Like, did you think, okay, this is how it's going to be permanently? Or do you think there's a certain level of like, hey, there's some stuff that can be done remotely, obviously, and it's changed people's opinion, but do you think there's a level of, hey, we got to get back into person at least a little bit?
I think there absolutely needs to be a balance. I mean, one of the things at Merkle pre-COVID we had for years is we allowed a relatively large number of people to work remotely. And that creates real challenges, because if you want to have an in-person meeting or you want to have an in-person team building event, you've got all these people all over the place, and they either don't want to come, or you then have to manage the incremental cost of getting them there because they're not living near an office location. Now, your cost for office space is less because they're not requiring that. But there is a balance to be struck. And so I certainly believe in a model where you allow people to work in a hybrid fashion, right? Where you can do some things, some days at home and some days in the office. I'm not a big believer today, and it'll be interesting to see if the firms that are pushing back to full-time in the office will actually be successful. Because what we've learned is, one, it's not required to be successful. But there is a benefit from a hybrid approach to this. But the other thing I would just say is, as a guy who used to get up every morning at 5 to drive to downtown Chicago to avoid the traffic, and then potentially work till 7 to avoid it the other way, and the fact that if you were in that traffic, you might be in it 2 hours each way. I mean, that's 4 hours of time, either that I could be working further and or benefiting from personally. And that to me is the offset. And there's a balance now that I think people know that they can achieve, and I think people expect. They expect to have some of that latitude, especially when you can still run your business successfully. So it was certainly nice for so many people during that period, to our previous points around, if you were getting on a call but you needed to throw in a load of laundry, you could, right? Or if you needed to run an errand for 30 minutes to run to the local grocery to get some milk, you could. And so I think hybrid's the right long-term approach.
So you look at the population trends, and this has been kind of kickstarted by COVID, and businesses are on the leading edge of this, where you see people, I mean, it is a trend, right? People are moving out of Chicago. Companies are moving out of Chicago. Companies are moving out of New York, although I was just in New York, and it's still a great city, right? There's nothing wrong with it, but you can't deny the data of people moving from these various places to the South, right? People are moving to Florida. People are moving their companies to Texas. Just another big move the other week. Obviously, Elon Musk is down there now. Tennessee is booming. Nashville, the commercial real estate's off the charts, and they haven't really seen a slowdown in office space in those markets at all. Do you think this is a trend that continues for a long time? You mentioned trying to change the mix of where people are located. Do you think that's something as an operating person that continues for a while?
So what's interesting, I don't have enough of a feel, because I haven't paid attention to it for over a year, of what the office real estate market is like in New York. But what's interesting, and as you know, since you went to school with Maddie, my daughter, Maddie's been in New York now 4 years, but it was crazy, the amount of demand and limited supply for homes, condos, and apartments pre-COVID. Then the first year of COVID, there was a massive amount of supply, because people were like, I'm getting out of here. But the real estate market for residential in New York is off the charts again. You can't find anything. So it's unclear to me really how much the major metropolitan areas are going to be affected, both from a commercial and residential real estate perspective. I expect some, especially probably more on the corporate side. But I mean, there's no doubt that people are moving where they want to be now that companies have allowed them to work remotely. I have so many friends and family members who've taken advantage of that. And I think certainly people are gravitating to different places, either based on lifestyle preferences. You mentioned Naperville, but I split my time between Naples, Florida and Naperville. And I like to chase great weather and freshly grown local produce. So you can't do that, of course, right now in Naperville, Illinois. But there's things that are drawing people like that, but there's also things that are drawing and actually pushing people away because of the political divide in this country, right? There's people that are moving to Florida because of the things that the government has done and continues to do here, but there are also people leaving Florida for those reasons. So it's going to be an interesting next 5 to 8 years here on kind of the geographic distribution of the company, and where do people end up, driven by lifestyle and driven by politics.
Sure, yeah, and people forget, there's these pendulums that swing over time, right? And Texas used to be blue, California used to be red. Now It's just the opposite. So these things change. Let's wrap up, Neil, with a little bit on tech. And I know you're this is what you love. This is your passion. So what's the future of tech? You see the tech layoffs, right? Big tech, maybe overhired a little bit, we could say, during COVID, anticipating some demand that wasn't necessarily durable there. But the broad tech industry, and we keep trying to remind our clients of this, is driving the economy. The stuff that can be done today with robotics and automation and all the stuff that the cloud and all, just incredible. I mean, just an iPhone, the fact that you have a computer in your pocket that's that powerful. What's kind of the near-term outlook for tech? You got the layoffs, but then what's kind of the long-term outlook in your view?
Yeah, I mean, I think the tech market has been adversely affected, I'd say first and foremost, by stock price valuations. I mean, obviously you can go back through time, and I know you look at these charts in your field of as we start to go into these tightening periods where the Fed is raising rates, it immediately makes some of these higher growth, which again have been predominantly tech stocks, less attractive. The valuations pull back, the stock prices pull back. And then does that potentially start to influence with the combination of that and just overall tightening and the rising cost of credit, spending on tech in our clients? Are our clients' businesses also actually pulling back due to less spend driven by higher interest rates? And there's like a snowball effect on these things. And so I think at the end of the day, we're just in a cycle. And I think as inflation comes down and as the Fed starts to actually maybe, one, stop raising rates, or two, start to ease rates, we're going to see that fundamental shift come back, and people are going to be spending more money and they're going to be investing more in tech. I think the bigger concern about tech, honestly, and this is like more of a societal challenge. I mean, if you start to think about some of the technology that we have in the marketplace today, the different chat technologies, right? ChatGPT and artificial intelligence, and the things that we might be able to further drive automation. You mentioned robotics. How much are those things going to start to further displace employees? And like, what do we do with that, right? How do we deal with that? And if there's not jobs for those people to pivot to, does it actually create a societal challenge where we need more social safety nets to deal with those kinds of things? I probably think or worry more about like, how does that evolution take place, which is more of a 10-year plus horizon. I'm not concerned about tech spend recovering in the next 24 months.
What are some of the key technologies? Is like, am I right saying RPA technology, for example, robotic process automation? Are we already behind with that stuff, or is that like really the cutting edge? Is there other, like quantum computing? What are some of the core technologies you think companies are going to leverage other than AI?
Well, I mean, I think let's just talk about a few of the ones you mentioned, right? RPA. I mean, those technologies have been around for, 10, 12 years. And people have been able to actually apply process automation. But it's kind of like even the cloud, right? I mean, back in 2003, at Accenture, we created that technology consulting business. A part of that was an infrastructure consulting business. And we were talking about, and I led a lot of this with a guy by the name of Steve Nunn, on like, what's the data center of the future? How do we go from dedicated compute to some kind of a hybrid of dedicated and virtualized, which isn't cloud? And then now the advent of cloud, right? So much of that came into play in that 2003 to 2010 timeframe. And here we are, the back end of that 2008, 2009. I mean, the movement of compute or storage from on-prem, either in your own data center or a third-party data center, was still like 70, 80%, maybe 90% of what was being deployed, and the other was cloud. And now that has significantly shifted, and I haven't pulled the stats later, but I don't think it's inverted yet. I mean, I think there's still a lot of take-up, because again, we talked about earlier in the call, these massive bases of applications and infrastructure on all these various technologies, and it's cost prohibitive to move them forward. And so, I think there's still obviously runway on cloud, and I would say probably some fairly significant runway still on cloud. I think things like RPA, it's obviously been deployed and applied, but it's probably not 50% at saturation, is my guess. And then you have all these new things, right? There's so much that's been going on now with data and the creation of analytical models and business insights. But that's now going to a completely different level with things like artificial intelligence. And that's going to continue to be a huge, but we're on the precipice of AI, right? We're not on the tail end of deployment, where you've got 80-90% saturation in enterprises today. ChatGPT, I mean, there's all these things, right? But some of these technologies are going to bring so many new questions. Like, I mean, just like ChatGPT, like how, that's going to be, and is already, you're seeing some of the early signs of how disruptive it can be, but how is it going to be managed? How is it going to be done in a way that doesn't infringe upon copyright law? I mean, there's just so many things that are going to have to still be sorted out on the governance of how these technologies are applied and to what degree they can be applied. And then, you know, robotics. I mean, we've had robotics for decades, especially if you think about automotive manufacturing and assembly lines. But, you know, I traveled to Japan recently with our son, who's decided to step away from the advertising and talent management field to actually be a chef. So he had spring break and we went to Japan. And I was astonished both in LA, LAX, and in Japan about the interactive robots generally out in public.
Wow.
Which I hadn't really seen so much in Naples or Naperville. So I think there's just tons of waves that we're going to continue to go through. I think the pace of technology change will continue to accelerate. And again, I think it will create tremendous opportunity from an investment perspective. And of course, from the advancement of enterprise capabilities and society. The question then is, how do we just balance all that out with the things that it displaces? That's going to be interesting.
So why is technology, especially in the U.S., you know, tech as a percentage of our economy is so much bigger than all these other places, other than maybe Taiwan? Taiwan's like almost 100% tech, right? But why is it just taken off so much, especially in the past 5-10 years, and why has it happened in the U.S. so rapidly?
Well, I mean, I think you could argue today that it's taking place not only in the U.S. It's certain. You mentioned Taiwan, which is obviously where a lot of, for example, chip manufacturing capabilities exist here and there. China, though, is and will continue to be a force to be reckoned with on a variety of fronts. I think again, it also depends on what kind of tech. Like, did you know that Israel is like a major center for software development and advancement, right? Obviously not hardware or chip manufacturing. And so, I mean, I think, you know, you see technology as major parts of various economies. I mean, the reason why the U.S. has and continues to lead that is because so much of it was actually created. The birth of it was here. Our institutions, educationally, are so focused on it. When you think about schools like the University of Illinois in our backyard, or you think about Stanford and so many of these, MIT, I mean, we could list them. I mean, just the things that they're doing, kind of at the intersection of industry or business and education, and the joint collaborations between companies and our educational institutions. I mean, we're still considered the best place for people to come for undergraduate and graduate degrees when you think about tech as a sector from other countries. So I think I mean, it's just because it was born here and has thrived here and continues to thrive here.
So last question for you, Neil, and correct me if I'm wrong. Feel free to correct this statement, but to me, you sound like a cautious optimist, right? There's some things you're worried about. There's some things you're concerned with. Obviously, we all are. And part of your job is to help companies manage risk. So we all want to do that. But you do sound optimistic, and I think there's some things that you're looking forward to. What's your take on the U.S. economy? What's your take here the next couple of years after we kind of sort out inflation, which could take us a little bit to sort out? But really, where do you think we go the next few years?
Yeah, I mean, I would say that you've categorized me properly. I'm a guy who still likes to talk about and dream about the ability to time the market, which we know for the most part actually isn't possible. But I still have hopes that I could do a better job of timing the market. But as I think I shared earlier in the call, I mean, I think we're going to continue to see further slowing this year. I don't think we're going to see a massive recession unless some other shoe were to drop here. I mean, the geopolitical challenges globally are quite concerning. I mean, the war in Ukraine, the things that are being done from a jockeying position with China. There are some major things here, Nick, that could be more disruptive and further affect the global economy and push us into a global recession. Right now, I would say I don't think we're going to go into anything extreme, and I do think we'll see some recovery even back half of this year, but next year is currently what I'm assuming.
Fantastic. Well, Neil, thank you so much for joining the show. Ladies and gentlemen, 110th episode of the show. Thank you for being with us. These are the stories we're trying to bring you each and every week. We're trying to give you a front row seat into what we see in the background of what's going on in the U.S. economy, that things are not as bad as they seem. It's not the doom and gloom. Yes, we have to be cautious, and we have to be cautiously optimistic and look at risk, but these are the stories of entrepreneurs, people like Neil, that we want to bring you each and every week. Thank you for being here. We'll be back next week with episode 111.